Welcome to the deep dive. We take your source material and we cut right to the knowledge that really matters. If you're prepping for a big meeting or you're just trying to get your head around the levers of modern business, or maybe you're just curious how companies go from just selling stuff to actually, you know, making money, you are in exactly the right place. Today, we're doing a really crucial deep dive. We're going right into the core of financial planning, cost, volume, profit analysis. You'll see it called CVP. I mean, think about it. Most managers are reactive. They look at a P&L statement and ask, okay, what went wrong last quarter?
Bon,
CVP.
quand
This
c'est
is a
so
tool that flips that whole script. It helps you become proactive, asking, what do we have to do next year to hit our goal?
And that's the whole game, isn't it? That shift from reactive to proactive. So our mission here is to walk you through the entire CVP framework. We'll start with, honestly, the single most important concept and then build out from there. But at the end of this, you'll have the tools to answer some really critical strategic questions. Things like, how much of a sales dip can we handle before we start losing money? Or a really interesting one, if our factory is at max capacity, what's the absolute minimum price we have to charge just to cover our costs? We're basically handing you the keys to the engine for strategic decision making.
Okay, let's unpack this. And I think we have to start with the concept that everything else is built on, the contribution margin. I see it defined pretty simply. It's just sales revenue minus variable costs. So why is this specific number? Why is the contribution margin the hero of this story?
It's the hero because it isolates the money that actually matters for, well, for survival. When you make a sale, you immediately have to pay for variable costs. The materials, the direct labor, maybe the packaging. That money is just gone. Poof! The contribution margin is what's left over. It's the money you actually get to keep from that specific transaction.
So it's not the final profit.
Mm-hmm.
Not yet. But it's kind of the true measure of how efficient a single sale is. Let's use those examples from the source material. I think they make it really clear.
Yeah, let's do that. Think about a simple hamburger stand. They sell a burger for $2. And the variable costs, the bun, the meat, the person flipping it, come out to, say, $1.40.
So the contribution margin is 60 cents.
60 cents. That 60 cents is what that one little transaction contributes to the overall health of the entire business.
And if we scale that up, like to a full restaurant meal, let's say it's priced at $15.
Okay, $15. And the food, the ingredients, the chef's time for that plate, those variable costs are $9.
So your CM is $6 per meal. And now you've got this pool of cash that's $6 and had a very specific job to do.
Precisely. That is the critical mental model. That $6 or that 60 cents, it's like a war chest that you're filling up with every single sale. And before the company can make a single dime of profit, every dollar in that war chest has one job first. Cover the fixed costs.
The rent.
The rent, the salaries for your admin team, the insurance, all the stuff you have to pay no matter what.
So when we say contribution to what?
Right.
We're not talking about profit yet. We're saying it contributes to paying down those big static bills.
That's it. And it instantly changes how a manager thinks. You stop just celebrating total sales revenue. Instead, you look at every sale and you ask, how quickly is this helping me knock out my fixed costs for the month? Because once those are covered, that stream of money, it just switches gears. Every CM dollar after that point flows straight to profit.
Which brings us to needing to know your costs. Before we can even use the full CVP equation, we have to get really good at understanding cost behavior.
Absolutely. This is the first hurdle. If you get fixed and variable costs mixed up, the whole analysis is basically useless.
Okay, let's start with variable costs. You mentioned the meat and the bun. These are costs that are constant on a per unit basis. So if a steering wheel for a car costs $150, that's the cost for every single car you make. But, and this is key, the total variable cost goes up with volume.
Right. The more cars you sell, the more you spend on steering wheels. It's a straight, upward sloping line on a graph. Now compare that to fixed costs. These are the costs that stay the same in total, at least within a certain range of activity. Think of your factory rent. Let's say it's $2,300 a month. Whether you make one product or 10,000 products, that rent check is still $2,300.
And what's so interesting there is how the per unit cost behaves. If you only sell one unit, that one product has to absorb the entire $2,300 of rent. But if you sell 10,000 units, suddenly the rent cost for each one is tiny. This is what creates operating leverage, right?
That's the term. The higher your fixed costs, the riskier your business is if sales drop. But the faster your profits explode once you get past that break-even point. And to really analyze that, managers use something called the contribution margin ratio.
Which is just the CM per unit divided by the selling price.
Exactly. And the reason you want a ratio is that it lets you compare things. You can compare different products, different companies, even whole industries. If your CM ratio is, say, 45%, you know that for every dollar of sales, 45 cents is available to cover fixed costs and then become profit. It tells you your power in every sale.
So, with that, we can lay out the foundational CVP equation. It's profit equals sales revenue minus your total variable costs minus your total fixed costs. And this leads right to what the source material calls the managerial masterpiece, the contribution margin income statement. It's structured differently. It goes revenue minus variable costs, which gives you the contribution margin. Then you subtract fixed costs to find your profit.
And that separation is everything. A traditional income statement just mixes fixed and variable costs together. You can't see the moving parts. The CM statement explicitly shows a manager, here is your leverage from sales, here is your overhead burden, and here is the result. It's the blueprint for all the what-if planning we're about to get into.
Okay, let's apply this engine. First and most important application, calculating the break-even point. This is the sales volume, in units or in dollars, where your profit is exactly zero. You're not losing money, but, well, you're not making any either.
Right, we're just rearranging that CVP equation to solve for the quantity needed to make profit equal zero. And the formula is, it's actually really elegant. It's just your fixed cost divided by the contribution margin per unit.
Let's use that baseball glove manufacturer from the sources, Jules Corporation. Their fixed costs are $63,000. They sell a glove for $200, and the variable cost is $110. So that gives them a $90 CM per glove.
So you take the $63,000 in fixed costs and you divide it by that $90 CM.
And that gives you 700.
700 units. That's it. Jules Corporation has to sell exactly 700 gloves to break even. When they sell that 700th glove, they've generated just enough CM to perfectly cancel out their fixed costs.
But what if a manager needs to know the break-even point in sales dollars?
Yeah.
Especially if they have a ton of different products, that's where the CM ratio comes back, right?
It does, yeah. So if the selling price is 200 and the CM is 90, the ratio is 90 divided by 200, which is 45%. To get the break-even in sales dollars, you take your fixed costs and divide them by that contribution margin ratio.
So 63,000 divided by 0.45
is $140,000. It's a nice, clean target for the sales team. Go generate $140,000 in revenue, and we've covered our base.
Now, this brings up a really important practical point, a rounding rule. The numbers aren't always that clean. In one of the other scenarios, the calculation for break-even units came out to something like 1,069.767. You can't sell part of a product.
No, you can't. And this is where a manager has to be a little smarter than the calculator. You always round up to the next whole unit. So 1,070.
Why up?
Because if you only sell 1,069 units, you are still technically short. You haven't generated quite enough contribution margin to cover that last little bit of fixed cost. You'd actually be operating at a tiny loss.
So rounding up to 1,070 guarantees you've crossed the line. You might make a tiny 50-cent profit, but you are officially in the black.
Exactly. It ensures you're safely in the profit zone. Once you master breaking even, well, now we can aim for the real goal. Target profit.
And this is just a small tweak to the formula we just used.
A very small tweak. Instead of solving for zero profit, you just treat your desired profit like another fixed cost you have to cover.
So the formula becomes units equals fixed costs plus your target profit, all of that divided by the contribution margin per unit. Okay, back to Jules Corporation. They have their $63,000 in fixed costs. Now let's say they want to make a profit of $36,000.
So you add them together. They need to generate a total of $99,000 in contribution margin.
And you divide that by the $90 CM per glove.
Mm-hmm.
And that gives you 1,100 units.
1,100 units. And that is the heart of managerial planning. You just translated a financial goal from the boardroom into a concrete sales target for the team on the ground. And this is where the planning power of CVP gets really interesting. Risk assessment. We measure that with something called the margin of safety.
That's a huge concept. It gets used all the time, but it's not always taught with the basic CVP stuff.
Yeah.
So what is it?
It's your buffer, your cushion. It measures how much your sales can fall before you dip below break even and start losing money.
And you calculate it as your actual or your budgeted sales minus your break-even sales.
Right. So if Jules budgets for 1,100 units to hit that profit target and their break even is 700 units, Their margin of safety is 400 gloves.
400 units.
Yep. And as a percentage, that's 400 divided by the budgeted 1,100. It's about 36.4%.
Which means their sales can take a 36.4% hit before anyone needs to panic. That number is, it's priceless for planning, especially if you think a recession is coming.
Absolutely. And this same thinking lets us solve for other unknowns. Let's go back to that constrained scenario. What if Jules can only make 600 gloves? They have a capacity limit.
And they still need to break even. What price do they have to charge?
This completely flips the equation and shows you how CVP informs pricing. Okay, so we know the total variable cost for 600 units is $66,000. That's 600 times the $110 VC.
And they still have the $63,000 in fixed costs to cover.
So they need $129,000 in total revenue just to break even on those 600 units.
And to get that from 600 units, you just divide 129,000 divided by 600.
Gives you a required price of $215 per glove. That's $15 higher than their original price.
Yeah.
The analysis tells the manager exactly what their capacity constraint is costing them.
And one final thing. CVP helps with product mix decisions, too. If you sell multiple products, it's not just about which one has the highest contribution margin.
No, it's about the highest CM per constraint. This is such a powerful idea. Let's say product A has a CM of $50 and product B has a CM of $40. You'd think product A is better, right?
On the surface, yeah.
But what if product A takes 2 hours of machine time to make and product B only takes 1? Product B is actually generating $40 in CM per machine hour. Product A is only generating 25. If machine time is your bottleneck, CVP tells you to push product B hard.
Okay, let's pull all this together. What are the big managerial takeaways?
I think the biggest one is that CVP isn't just some accounting formula. It is the ultimate tool for strategic leverage. We talked about the margin of safety for risk assessment, but it also directly informs your budgeting and control. When you know your cost behavior inside and out, you can accurately plan for big changes, like what if we outsource this function or sign a new lease? How does that shift our costs and our break-even point?
And it makes your planning so much more robust. You can set realistic sales targets. And because you've separated variable and fixed costs so clearly, you know that every single dollar you can shave off a variable cost.
Say, by getting a better price from a supplier.
Right. That dollar has a magnified effect because it drops straight to the contribution margin and then straight to profit.
Ultimately, CVP analysis is the bridge. It connects raw sales activity to actual business strategy. It turns you from a passive observer of financial statements into an active forecaster.
It gives you the clarity you need to navigate economic downturns or confidently plan for growth. So we walked through the whole system. Identify your cost behavior, calculate the contribution margin, apply the equation for break-even and target profit, and then use that for risk analysis. Now here's a final thought for you to chew on, something that connects this analytical power to real-world competitive strategy. We calculated that Jules Corporation, when they were constrained, needed to charge exactly $215 per glove just to break even. What if a major competitor suddenly drops their price to $210? Knowing that you must charge $215 to avoid a loss, how could a manager use this CVP data to compete? Does the need for market share ever justify running a short-term but very calculated loss? Think about that tension between short-term pain and long-term survival.